Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Tuesday, April 29th. For the last 6 months, it has been a foregone conclusion that the Federal Open Market Committee, known as the FOMC for short, would cut interest rates at its policy meetings. With the April 30th meeting, it isn't such a foregone conclusion, but it is close to one. At midday Tuesday, the Fed funds futures market was pricing in an 82% probability of a 25 basis point reduction in the Fed funds rate to 2%. The balance favors no cut in rates. The good news this time around is that the FOMC is not necessarily in a position where it has to cut rates. Since the last FOMC meeting on March 18th, the S&P 500 is up nearly 10%, credit spreads have narrowed, and economic data, apart from housing numbers, haven't been recession bad, suggesting the need for more monetary stimulus at this point might not be as great as months past. On top of this, inflation expectations are picking up with the rise in food and energy prices and a litany of corporate profit reports that have talked about the adverse effects of rising raw material costs and the efforts to pass them along to customers. At the meeting in March, though, it was clear that a further downturn in growth remained the predominant risk in the eyes of the committee, which said at the time it believed inflation would moderate in coming quarters. The escalation in commodity costs is putting the Fed's view to the test, but readers need to understand that employment costs are a much more important factor when it comes to inflation expectations, and with a loosening labor market, wage-based inflation pressures are expected to be held in check. Frankly, it seems unlikely that the Fed would hold off on cutting interest rates now on account of inflation concerns, since it understands it would be threatening its credibility with such a sudden shift in the balance of risks. Recall that the Fed's credibility got hurt last year when it got pinned in the awkward position of having to flip-flop on the risk characterization when it cut rates in September, citing growth concerns, less than 6 weeks removed from a directive issued in August that suggested inflation risks were its main concern. In all likelihood, the FOMC will cut rates another 25 basis points at this week's meeting. It has the justification for doing so given the continued deterioration in the housing market. However, look for a statement that emphasizes the Fed's desire to monitor the impact of past rate cuts on economic activity and which places a stronger emphasis on the Fed's attention to inflation risks. In brief, look for a statement that will lead the market to believe the FOMC is essentially done with this rate-cutting cycle. I'm Pat O'Hare for Briefing.com. Thanks for listening.